Hi friends, this is Ravi Kanth Miriyala. Right, my classes on CA final paper number 1 financial reporting are available on an academy platform. Yeah, these are recorded as well as live, and it is 100% comprehensive and 100% English batch, wherein we discussed each and every concept of Ind AS, which will be useful to the students even after qualification for practice purpose. Also, this will be useful. Yeah, please, inform your friends about this information. And on an academy platform, comprehensive batch on GFRS also is done. 23 classes, 69 hours, entire ICA material with PY examination questions and mock test papers also are covered in this discussion. It will be very much useful for CA final GFR, that is paper number 6E. Next, for my books, that is on Ind AS made easy, our financial reporting made easy, and fast track summary book. Yes, you can order in ravikantmiriyala.com, or you can contact the given number for the books. Right, for your doubts, clarification, please join the Telegram group Ind AS discussion group RKM. These charts are from my quick revision fast track charts on financial reporting book, which is available in the market. Let's look at Ind AS 37, which is provisions, contingent liabilities and contingent assets. When you see the applicability, this is not applicable to the provisions which are already covered by other standards, and it is not applicable to financial guarantees or financial liabilities and executory contracts. What is a provision? Provision is a liability of uncertain amount and or timing. What is a liability? Liability is a present obligation arising from the past events, on settlement of which expected future economic benefits outflow. Present means which is existing or outstanding on the balance sheet date. Obligation, which is a duty or responsibility, right? And which is arising, which is a duty because arising from the legal contracts, or it may be statutes, that is contractual obligations or legal obligations, or it may be because of the business practices, which are nothing but constructive obligations. Constructive obligations are nothing but because of our practices which created a valid expectations in the minds of the other party that we are going to fulfill the things, right? When can you make a provision? Provision can be made when three conditions are satisfied. One, there is a present obligation arising from the past events, probable future economic benefits outflow, and reliable estimations can be made. Probable, right? Probable means which is more than, more likely than not. That is more than 50% chances to occur. Next, when you see provision for depreciation, no, it is not a provision because there is no liability. Provision for bad and doubtful debts, that is also not a provision. You should use correct word, allowance for doubtful debts. Rent payable, these things, there is no uncertainty, and great extent of uncertainty does not exist. That's why these are supposed to be called as outstanding or other current liabilities, but you should not use the word provision, right? When you see how do you measure the provision, this is based on the best evidence available. You can consider the expert opinion, you can consider the events occurring after the balance sheet date, and the best evidence as on the not on the balance sheet date. When you're preparing the financial statement, that date best estimation also can be considered. There are two ways to measure. One is expected value method, which is nothing but weighted average of probabilities, and the second one is single most likely outcome, which is single most likely outcome, wherein the answer is going to be either yes or no. There we should use this one. When you are following single most likely outcome, then percentage of probabilities are not at all supposed to be looked at, right? And when you these provisions, contingent liability, contingent assets, are supposed to be reviewed on every balance sheet date, and if there is any a change in the estimation, that is supposed to be adjusted immediately. Whether the provisions are supposed to be present valued, discounted for, yes, all the provisions has to be discounted for. You are supposed to apply Government of India bond yield rate, and supposed to be adjusted with the risk specific to the liability, right? Okay, provision is supposed to be credited, we know it. Whether should I debit it or credit it? that is, I mean, no, that should be credited, but what should be done with respect to debit? Yeah, whether shall I debit the expenditure or debit the PPE? Yeah, for this straight question, whether, I mean, is it directly attributable, is this provision directly attributable to a PPE, like decommissioning expense provision, restoration provision, rehabilitation provision, something like that? If you say yes, then you have to debit it to PPE, respective PPE. Otherwise, it should be charged to profit and loss. Subsequently, if there is a change in the estimation, correct now, subsequently there can be change in the provision. That can be because of, I mean, amount can be changed, or the rate, I mean, just now we have taken Government of India bond rate, that rate also can be changed. If the change is in the expected amount, then that debit, I mean, you are increasing the provision, reducing the provision, corresponding entry corresponding should be given to the either PPE or to the profit and loss, what you have initially done it. Yeah, if the change is because of the change in the interest rate, that is Government of India bond yield rate, then it should be charged to finance cost, that is profit and loss things. Okay, right, let's look at that. That's it about provisions. Contingent liabilities, there are two definitions with respect to contingent liabilities. One, it's a possible obligation arising from the past events, right, the existence of which will be depending upon the occurrence or non-occurrence of one or more future events which are not under the control of the entity. Yeah, it's a possible obligation. Possible, you know, that is less than or equal to 50%, but it is beyond, I mean, it is not remote, right? And there is a second definition, it is a present obligation arising from the past event, but we cannot make a provision because the other two conditions of the provisions are not satisfied. That means either we are not in a position to say that probable future economic benefits are outflow, or we are not in a position to measure it. Under these two circumstances, we can say it is a contingent liability. Contingent liability is a caution. That's why disclosure is mandatory in the notes, right? Bills discounting is not a contingent liability. You have to refer Ind AS 109. And financial guarantee, it is not a contingent liability. Again, you are supposed to refer Ind AS 109. Right. With respect to contingent asset, there is only one definition, that is contingent asset is a possible asset. Remember, it is a possible asset, existence of which will be confirmed by occurrence or non-occurrence of one or more future events which are not under the control of the entity. Right. So it is a possible asset. It is not a present asset, and it is not a probable asset. So that's why if it is a possible, you should not disclose, you should not recognize it. If it is probable, disclose it in the notes to financial statements. If it is virtually certain, then you recognize it as an asset. When you're recognizing an asset, there is nothing to do with contingent. Directly recognize it as an asset. Yeah, there is one more small topic, that is reimbursement of expenses. We spent on behalf of somebody, and is it an asset to me? Yes, you can recognize it as an asset, but only when there is a virtual certainty. That means other party must have agreed it in writing. There must be some contract and there is a guarantee, virtual certainty, then you can recognize it as an asset. With respect to reimbursement expenditure, in the profit and loss, you can do reimbursement, total expenses incurred, reimbursement, how much is going to come, net amount can be charged to P&L. But with respect to balance sheet, you are not supposed to offset. Yeah, whatever you are supposed to pay to third party, that will be a liability. Whatever you are supposed to receive from the other party, that should be an asset, because it is arising from two different parties. Next, onerous contract. Yeah, onerous contracts are which are unavoidable cost from non-cancelable contracts. Non-cancelable contract. Yeah, under this circumstance, what is the loss if you continue with the contract, or if you cancel, what is the penalty? Whichever is the lower money, that money you are supposed to make a provision immediately. The reason, because it is non-cancelable, that's the reason you are supposed to charge it off. You are supposed to make a provision, and obviously debit will be charged to profit and loss immediately. The next small topic is restructuring of provision. Restructuring is a program planned and controlled by the management, which will have a significant impact on the scope of business. Or the manner in which it was conducted. Yeah, anything, because see, first of all, restructuring provision is purely a constructive, meaning any provision is arising from the restructuring is constructive provision. That, right, that does it satisfy the three conditions or not, you are supposed to you're supposed to ensure it, and you are supposed to accordingly make a provision. There are no other additional conditions. The same three conditions of provisions will be working, right? That's it, my dear. This is about Ind AS 37 quick revision. If you like this video, please share it, like and comment. Let that be helpful to other students as well, and wish you the best.